Thiam, thank you so much, as always, for giving a little bit of your time to Bloomberg. Smaller loss than expected, higher revenue than expected. Are you pretty much happy with the results?
Well, I think we're pleased with the way things are going. This was just and only the second year of a 3-year program. If you look at profit and the target we gave from 18, we are at 85% of that target after 2 years. And if you look at cost, we're at 75% after 2 years. So we should be 2/3 of the way. So I think it's fair to say that we're well ahead. Revenue is up 5%, cost is down 6%, profit is up 349%. Cost, we said we started at 21.2 billion. We're hitting 17.7 in 2 years. We took out 3.6 billion of cost and didn't destroy the revenue line. So which leads me into my almost biggest satisfaction, which is odd to say at a Q4 result, is Q1. The start of the year, and we talked about it in Davos, has been very, very strong. We indicated some numbers. Global market revenue up 10%. You have to remember Q1 last year was very strong for us. So we're up more than 10% on a very strong quarter. And in the places where we wanted to see a change. Securitized product has continued to be strong, but equity derivatives, which was really a problem for us, we rebuilt the team last year just at the right time for the market pickup. And the central point for me is when you restructure and cut costs, you always wonder if you've damaged your franchise. The test was always going to be when there is an upturn, whether you can participate. And the most pleasing thing for me has been to see that our franchise is intact, actually vibrant. And that was, if you wish, the last challenge in the restructuring. Because the wealth management is going well. It was all about global market and Asia market, which is also up more than 15%.
Yes, volatility, so 10% in global market revenue. More than 10%, more than 15% or 15% in revenue in APAC. Does that actually impact your return on capital?
It impacts our return on capital very much because both businesses then become significantly profitable. It generates very good returns for 18, definitely. Capital generation probably hit 4 or 5 billion this year. And as the SRU is going to be closed down, it really sets the stage for very, very good 18 and very good 19.
But the volatility, how does it impact your wealth management unit?
Look, volatility means that people, actually it creates opportunities. People see it as a negative, but actually for anybody, it creates opportunity.
If you're on the right trade.
Yes, but people, the kind of people we work for, the ultra-high net worth, you will have seen that was a key part of the strategy. And their participation in our new flows went from 50% in 15 to 75% this year. So that strategy is really working. They are sophisticated investors. They understand markets, and they see volatility as an opportunity to trade. So we're actually trading more, which increase our trading revenues. And if you take asset management, which has more than doubled its profit this year, it's one of the bright spots, 16 billion of inflows, 2/3 of that come from our wealth management, the ultra-high net worth. So that connection is very strong.
But are there parts in the market, in the volatility, where actually people say, I don't want to transact at the moment? So does it hold back certain units?
It's hurting the primary market.
Right.
And we said that in the release. We see a lot of activity in the secondary market, so global market, but the primary market issuers are reluctant to issue when volatility is high. So as things seem to be settling down now, we should face a better period. We actually don't believe that what we've seen is a major disruption. The correction was unavoidable, I think, in equities. Everybody expected it. We look very closely at the credit market in both situations and the spreads. And investment grade and the credit market have held very well. High yield has suffered a little bit. But you haven't seen a contagion, which means that the fundamental economy, fundamentals are healthy. You see the growth in the US, unemployment at a historic low, growth in Europe is coming back, growth in emerging markets is very strong. So with those fundamentals, with company earnings going up, plus the impetus from the tax reform in the US, we don't see a downside scenario in this economy.
Do you expect a contagion to credit market, or is it too soon to say?
We don't expect one, because we think credit markets will hold because the economy is so strong. The underlying economy is so strong. There's no prospect of defaults or unemployment, which generally then slows down consumption, impacts the mortgage market, etc. You don't see any indications of such negative developments.
Just going back to your return on capital, so your target range is between 10 and 15%. So the volatility, does it make you closer or more confident about that target?
Actually, several things are helping. It's helping our revenue line, but also the tax reform is basically adding 100 basis points to our return on tangible equity.
Right.
And we put that in the release. So that's a big boost. So, and then it's really the two stories of operating leverage, which is increasing the earnings, and closing the SRU. We had 3 billion of losses in 16. We had 1.9 in 17, so 2 billion improvement, and then 1.4 in 18, and then we're done. So after that, you can see the power of the franchise coming through.
Talk to me a little bit about the ETN that you had to close last week.
Yes. It's an excellent trading note.
Yeah.
I want to go back to the literature because I've had to read the prospectus myself. And it says a number of very important things. It says that this is a daily trading tool for very sophisticated investors to help them manage their daily trading risk. So it's really, we also say that your ETN has zero long-term value. It's the first time I saw a prospectus that says that the product has zero value. And we also say that it is not an appropriate investment, and you should not invest in it for any period of time superior to 1 day, because you risk losing all or a substantial portion of your investment. That's the language in the prospectus. So it's a tool used by hedge funds and sophisticated investors to manage their risk intraday.
Right.
So
it wasn't sold to wealth management clients or retail clients?
Actually, we don't sell it. We manufacture it.
Right.
There's a third party who sells it, and we sell it to market makers only, and we are not a market maker in the VIX. So really, that's all we can say about this. The prospectus is crystal clear. It is not a proper investment vehicle. It's a risk management tool, and we say, black and white, this should not be used as an investment vehicle.
Why did it blow up so quickly?
Oh, it's because of a formula. When the VIX went from, it's the inverse of the VIX. So when the VIX went from 17, to give you some numbers, to 38, let's call it, the value of the instrument went from 100 to 5. And the reason then we close it is that there is no prospect of recovery. If the VIX went back to 17, from 38 to 17, the value of the product will go from 5 to 10. So once you hit that bottom, the structure of the product means there is no recovery, which is why it was from the start in the prospectus that should the product lose more than 80% of its value, we're allowed to close it. Everybody who holds it in the market understands that that's the nature of the product, because it doesn't work anymore. And when the conditions to withdraw it were explicit, it will be trading until February 15, so we didn't just close it, and the investors will be paid on February 21st. So all that was laid out in the literature of the product.
So the rationale makes sense. Do you think there'll be more products like this or less products?
Well, I think there are quite a few products like this in the market. It's interesting. At least one other bank made the same decision we made that night, and it was actually to protect investors because the product stopped trading. It was quasi impossible to price, and we needed to give certainty to the market at the market open. So before the morning, and we went through a long process. We don't make those decisions lightly. There are people involved from every aspect of the business, from compliance to the front office, and they collectively, I don't make those types of decisions, they collectively reach a decision which was in the interest, we believe, of investors, which was to close it. But there are quite a few products like that in the market because they serve a useful purpose. They allow market participants to manage their risk better.
Thiam, talk to me a little bit about global markets. Are you more or less happy of where it is? Are you a little bit disappointed? Could it have done better given all the restructuring you've done?
No, we had a loss in Q4, which was expected. I think enough banks have announced that you can see what happened. Actually, fixed income was up in Q4, 5%. Its equities were down 16%. And we had a bit of a gap in revenue. But we ended at the guidance we gave at Investor Day. We said 5.7 billion of revenue. We hit that. And we said 5 billion of cost. We hit that. So profit is up 118%, 17 over 16. And then Q1, I couldn't be more pleased with global markets performance. I'm actually quite proud of what the teams have done in the market disruptions. We have de-risked the business so much that we have gone through the last 6 weeks without any major issue. On the contrary, with a very, very significant upside. So I'm actually very pleased because that was the last, if you wish, sticky point in the restructuring. Global market and APAC market. With those two, be able to hit their targets, and they're well on the way to do that. And the teams have gone through a lot of restructuring and very deep restructuring. And the fact that they can still perform 10% revenue up, 15% revenue up in these markets is very, very comforting and pleasing.
So you're basically saying that the last 6 weeks means that your strategy in those both units is validated.
I mean, it is. After that, markets can, that's why we're cautious. Yeah. I may sit here at the end of Q1 and tell you, well, this happened in March and things turned. Yes, but what you want to see is that the potential is there to outperform. It's like a Formula 1 car. You want to see that the tires are working, the engine is working, and the potential is there. So you're waiting for an upturn to see, are we going to take our share of this? And right now we've taken more than our share, and that's extremely pleasing. So we're recruiting. We invested a lot in 2017 to recruit, particularly in equity derivatives, which is a historic strength. That's doing very well. And I don't want to forget ITS, which was the other big thing we created in 2017. That's also doing extremely well. We just did a note in Brazilian real, more than 1 year. It's a capital guaranteed note with an upside. And the demand for that from our wealth clients is huge, and it went very well. And ITS is coming up with a whole pipeline of ideas. We'll talk about them this morning, which are working very well. So all that is coming together nicely in 2018.
Any update on the cost cuts?
Look, we were very clear. We said one thing about the cost cuts is the run rate. We came into 2016 with 21.2 billion. We came into 2017 with 19.4. We're coming into 2018 with 17.7. And one thing that hasn't completely been taken into account in the market is the power of that momentum. The reason you're seeing that acceleration in our profits is that in 2016 we restructured deeply, reorganized everything. 2017 was an undisrupted year where that new organization could produce, and you can see the inflection. IWM went from 1.1 billion to 1.5 billion. Asia, even more up. Ended up hitting its 18 target in 2017. Switzerland is now at 1.9 billion. We started at 1.5. So that momentum, once you cut the cost and you lower the fixed cost base, you really increase your profitability very much. Right. And if you have a bit of a tailwind, then it takes you very far.
Thiam, one final question on the Swiss Universal Bank. Are you confident about targets there? And where do you see revenue coming from?
Yeah, well, that's fantastic. Because actually, that's been one of the issues in 2017. Cost performance has been very good, but we lost a little bit on revenues. And it's mostly ITS. Again, it's the trading and the low volatility. That's coming back very strongly in Q1, and we're going to do additional things. We have hired this Bank for Entrepreneurs strategy we're driving for the ultra-high net worth. Switzerland has a lot of those. So we have lost share there. We've hired several tens of relationship managers. I've visited some of them in Bern, etc. And we have entrepreneur-focused teams across Switzerland now driving that, and the very early results are promising. We're running deposit campaigns to attract more deposits. You may have seen Diggy Piggy, which is a very neat invention for younger people. We're trying to attract younger clients, and we have a very strong investment banking pipeline. We were number one in Switzerland in investment banking last year, and we have a very strong pipeline coming into 2018. And we are also, with ITS, selling more of our structured products to our ultra-high net worth clients. So between all that, we're confident that revenue is also going to get some traction.